For a first live, I guess I'm okay with that, especially on a Monday night. I mean, people got better things to do. They've got Netflix. They can watch shows on Netflix. Maybe sit on YouTube and watch some reality TV crap. You know, why? Yo, Morel. Thanks for joining, man. Look, we're gonna kick it straight off now, guys. I'm done waiting for people that, you know, think they want to take things seriously but aren't really taking things seriously. So I'm not sure if you're aware, but basically the ASX, you would have seen it all over the news, dropped by about 7% today. So about $130 billion wiped out, gone from the share market. And it's important to know that they're saying, you know, the media says that it's basically, you know, it's the coronavirus and we're fearing it and that's what it is. But that was merely a catalyst for exposure into how bad and how fake this financial system actually is. And we're beginning to realize the ramifications of, you know, being an economy that's reliant on just one export and import partner, an economy being China. And I think the basic line that all media is saying is, you know, when China sneezes, we literally catch a cold. And now it makes sense with the coronavirus and all that, but it is affecting our economy as a whole, and we need to address it to become a bit more versatile. We need it to become more diversified in what we're exporting and importing. The Australian government have been very lazy in how they've approached this previously, where they've just gone, hey, China's success is our success, and we're just going to continue sort of fueling that beast because China cannot fail. Like, they're so amazing. And that's how we sort of, you know, bypass the whole GFC part of it, right? But this time, China's out. They're not going to help us, and our economy is effed. So without sounding so doom and gloom type, our economy is in bad shape, and a lot more is going to happen. So my thing is that you guys are taking your education seriously, getting not so much advice, because none of this is advice, but it's more so to start putting your blinkers on, start paying attention and becoming accountable. You know, in 6 months' time, when shit goes down, like it is already, and it starts affecting you, and you know, you start losing jobs, or the people around you start losing those jobs, you're going to say, oh, well, they didn't teach us this. How was I supposed to know? It's because idiots are spending time watching Netflix and not trying to really educate themselves, thinking, oh, well, no, it doesn't affect me. Oh, I'm just going to worry about memes on Facebook. Like, get your head out of your ass. Like, you need to start making those changes. Start committing to the fact that, you know, you work 40 hours a week and you work really hard, 40 to 50 hours a week. You're working really hard to make this income, but you won't spend 2 to 3 to 4 hours a week to understand, hey, maybe I need to take care of personal finance. Hey, maybe I need to understand what's actually happening in the economy versus, oh yeah, it's Friday, let's get a drink on. Like, it doesn't work like that. And just simply by working the 40 or 50 hours a week, you're not going to get wealth, or now it's trying to sustain a living for yourself. All those people that have literally been sitting there and piling money into their super, they would have lost at least 10 to 15% of it over the last 2 weeks. And I know personally there's friends that have gone, oh, I was on, you know, 100 and now I'm on 80. What happened there? So I know I'm jumping around a little bit, but anyone that's sort of joined recently, thanks guys for taking your personal finance seriously. You're not here for me, you're here for yourself. And you need to remember that as much as, you know, I get a benefit of you being here and I want to spread that education and a lot more of this knowledge, you need to just take this with a grain of salt and understand there are so many other voices out there, and it becomes hard sometimes to decipher which is true, what's most applicable to you, and what works best for you. So I've got a couple of points here that I wanted to talk about. So we've talked about the ASX. So the Australian stock market has dropped by 7%. We've lost like 130 billion. That's going to continue this week. We're going to see new lows. We are going to see very, very bad times in the economy. especially the share market. We've already been priced in for April. Another rate cut will happen. It's 100% it will happen, and then we will reach 0.25 as our cash rate. So for some people that don't know what that means, everyone just talks about, hey, interest rates and cash rate, what's the difference? So RBA, the Reserve Bank of Australia, is our central bank, and they dictate what the cash rate is. Based on that, the banks will then say what their interest rates will become, right? So we just recently saw a couple of days ago, last week really now, 6 days, where the cash rate was dropped by 0.25 and we're at 0.50 as a cash rate, okay? Now the banks have passed that on as 0.25, so they come into effect in the next couple of weeks. And that means more savings into your pocket because if you have a loan, right? Now, what's gonna happen, and you know, the RBA has already spoken about this, is that if we get to 0.25, which is 100% happening in April, then we will start having quantitative easing. Now, put simply, without getting into too much detail and complicating things, quantitative easing is basically printing money. Now, printing money, so more money comes into the system. So you're basically like, okay, if you can just print more money, then keep doing that and we can just pay down our debt. What that does is it devalues the currency, the local currency. So that is why we are at like 7-year, 9-year lows of our Australian dollar. Okay, so that's going to continue to go down as long as we go into printing money and you know, reducing our interest rates, right? Because that has adverse effects, which is, hey, if our Australian dollar is less, that means we can allow for people from overseas to come in, and that props up the economy, which is good. But in this case, we're seeing that it's a coordinated sort of attack where all central banks across the world are all reducing their cash rates. Now, what that means is for anyone that's got debt, okay, this is very important, and I'm not just saying this because I have a shitload of debt. I'm saying this because it is very applicable to anyone that's really young and can take advantage of this. We will never see this time again, okay? I don't know how to say this with any more emphasis. We will never see the same conditions we are in ever again, which means that if you're able to get in to the market, whether that's buying property or, you know, buying assets, accumulating assets, if you can get in the next year or 2 years, you are going to make gains and set yourself up in a position which was not possible previously for years. So in months you can create wealth that you would have had to accumulate over a period of years because of what's happening in the economy. If you can take advantage, but you have to be smart about it, right? So I'm going to talk about, you know, how exactly I'm going about doing that, and you can just do what I do. So don't, you know, look at what I'm talking about, rather look at my actions and then just follow the actions, okay? There's a reason I'm in so much debt and I want more. I'm basically going to the bank and saying, how do I get more debt? And that's because the debt is productive debt. People are getting it very confused going, well, I want to live in a house. I bought my own place, a principal place of residence, right? The difference between that and an investment is an asset is your investment, right? So your investment is an asset, whereas your principal place of residence is actually not an asset. It's a liability. And people often get sort of caught up in saying, well, if I bought this place and it's going to go up in value, it's an asset. Well, it's not, it's a liability. So we talk a lot more about that in our strategy sessions as to why it's determined that way. But what I'm saying is get as much debt as possible, because right now where the economy is heading and what the bank, you know, the RBA is trying to do is going to put you in a position where essentially, I'm going to show you basically the timeline of how this works. So we first got rate cuts, which started already, and they're going to continue happening. So we're going to get to 0.25, and the RBA said, well, you know, when we get to 0.25, we're not going to go into negative interest rates. That's a load of shit. because in the background, the banks are doing what they need to do to prepare themselves for when they go into negative cash rate, right? Territory. So the interest rates will continue going down, and that's going to prop up the property market, and everyone's going to go, ooh, like, you know, I can borrow money and it's cheap, and it is. So then they're going to go and buy more property. There's more demand, more people, you know, sort of all after the same property is going to really jack up that price, right? So once that happens, there's going to be a period where quantitative easing and stimulus package government spending is going to start coming into effect. So I think it was just announced that they're looking at up to $10 billion in stimulus being provided from the government, okay? So that's basically their way of saying, look, the economy's effed, okay? We need to now start putting money in and forget this stupid budget surplus crap that we've been talking about. We need to keep our economy from going into a recession, because the only thing we don't want to be remembered for is we were the government in place that actually caused a recession, okay? So they don't want that. So what they're going to do is they're going to start throwing money, and the stimulus will come in, and so everyone's going to get money coming in and they can start spending it, right? Now, most people, what they're going to do is going to pay down their debt, which is not what you should be doing, okay? They're going to get all this money, and money's cheap right now, right? So they're going to go, oh, okay, I can borrow more, but I'm just going to pay down all my debt. The government's going to give me money. There's concessions. We're going to get that, and we're going to pay down debt, because everyone's in this fear stage where they're going, oh my God, like if I've got debt and then I lose my job, what am I going to do? Truth is that if you've got a principal place of residence, you're screwed, because how the hell are you going to make your repayments? If you've got a $1 million loan for your house, right? You're in a position where you're paying, say, let's say 3%. That's $30,000 in just interest alone. So that's about $600 a week. Let's say you lose your job, right? If you lose your job, you've got to now fork out the $30,000 to pay the interest on that loan. Hence why your principal place of residence is a dumb idea. So again, you know, some people are at different age groups, but I think a majority of the people on here and most people that are listening to me on YouTube or whatever are in our young, you know, early 20s, early 30s, mid 30s, whatever. Right now, if you have been thinking about buying a principal place of residence, I'm telling you now, it is the worst decision you can make. What you want to be doing is getting assets that are basically allowing you to continue living your lifestyle. It doesn't take any money from your pocket, so that tomorrow, if you lose your job, you're okay. The reason why this is important is because the companies will start feeling the effects of it. They've already felt it. So retail companies are going under. The reason for that is people are spending a lot less, okay? So when they're spending a lot less, they can't hire as many people. So when they can't hire as many people, what happens? Unemployment goes up. Okay, so now people aren't able to fund their lifestyles, and they're in a position where they're paying off this, oh my God, I've got this really nice house. I've got a 5-bedroom house, but there's only 3 of us that live here. Like, stupid, right? And what's gonna happen is if you have investments, okay, then money's cheap. So you buy as many as you can, and weekly cash flow, it's taking care of it by itself, right? If you find the right areas. So you've got all these investments, and they're all, you know, going, you know, paying themselves off. The tenants are in there. When there are times of, you know, economic difficulty, your rents will go up, but your prices will go down. Okay, just remember that. So right now we've had some amazing times. The economy's booming, and it's been great. So the asset prices have been going up. Okay. But what's going to happen is most people can't take on loans anymore, because they're like, oh my God, like I don't know the security of my job. I'm going to rent somewhere. So then they start renting, right? And then there's less people to buy these properties. So once they start renting, that's actually a good thing if you're a landlord. So if you own property and you've got an investment, you're always going to have people renting, right? And that's going to jack up your rental prices. And then what happens is after they've introduced quantitative easing, after they've introduced all this government stimulus, that's going to lead to inflation, okay? Now with inflation, we always got taught in school, it's like, oh, how much does a loaf of bread cost? It costs more today than it did 20 years ago, okay? So with property prices, the reason why we're at like huge heights and it's like, you know, it's growing to whatever it is, and you could buy a house 20 years ago in Sydney for like $5, like exaggerating, right? But it's not because the price of the property has gone up. It's because our dollar has gone down in value. So we've lost, you know, 80-90% of the value of our currency. Okay, so something to understand here is if you keep plugging in more supply, the actual dollar goes down in value. It's very hard to explain without like a whiteboard. So maybe I'll do a whiteboard session about this in one of my YouTube videos. But once inflation comes in, you're gonna have a house, like you're gonna have property, right? And asset prices will go up, right? Inflation will cause everything to go up. So once your asset prices go up, your debt stays the same. Now, if your debt stays the same and your asset price is going up, you've now got more of a buffer. Now, you made more money in that recession or economic downturn than most people would. Because most people, what they're gonna do, right? And I hope none of you guys do this. Most of you guys are gonna get scared and you're gonna go, okay, I'm really scared. I better save my money. I don't wanna invest in anything. I just wanna save my money. The share market's effed. I don't know what to do. I'm just gonna save it. Now, if there's more money that comes into the system and after this period inflation kicks in, if you saved $10 20 years ago, $10 today is worth a lot less, okay? So $10 back then was amazing, but it's a lot less today. So most likely the $10 you have today will be worth a lot less tomorrow. However, if you invest that into an asset, like a hard asset, whether that be in gold or whether that be in property, what's gonna happen is the price of the asset will go up, but your debt will be in today's value. So your debt levels are actually gonna be worth nothing. So an example would be to, you know, really get you guys to understand this is if you bought a house in Sydney, let's say 20 years ago, let's say it was 100K and you still have 100K of debt on it. The 100K today means nothing. It's nothing, right? But the property has gone up to $1 million. So now, even if your debt remained the same, your asset value went up, and that's what inflation will happen. Inflation will cause, and that's what's going to happen in the system. So it's very important to now start really getting educated that $20,000, $30,000 that you got saved in your bank account isn't going to do shit. And whatever you've been working towards and whatever you've been putting money towards, like, you know, you've been working your job and you've been saving that, you're working free for close to 10 hours a week. That's what you're essentially doing by not investing into assets and using your head when it comes to, I need to start doing things that are outside of the norm. Right now, with all those interest rates getting cut, we're gonna get into negative interest rates, right? When negative interest rates come in, what's going to happen to the retirees? What's going to happen to all those people that were like, oh, wow, I'm going to put money into my super, I'm going to salary sacrifice, and then the market downturns, but then when you take out all your money, you're going to put it in a bank account, an interest saver account, right? And you start making what? It's like 1.5% now. Now, let's just do the maths here. If you have $500,000, okay, $500,000, 1% is $5,000 a year. So can you live on $5,000 a year? I don't think so. And so now you suddenly start questioning, what's the point of having super? Why would I have super if now I can take control of my own retirement by actually investing into assets that are going to pay themselves off? And if you start at 30, you're going to have, by the time you're 60, you're going to have a house for free, all right? It doesn't make sense for you not to start actually putting money towards those things rather than just saying, oh, I'm just going to do what everyone else does. I'm going to save my money and then I'm going to buy a place in Sydney and that's where I can live. Like, it doesn't make sense to be doing that. So the other thing I wanted to talk to you about was mortgage rates. Okay, so then you've got to think about safe havens, right? So at the moment, the share market obviously crashed quite a bit today. It's going into correction territory and then margin calls will be called. And that's basically where, if, without it getting too complex, right? What's this? I thought you can only take out of your super under certain circumstances. So I've got some questions coming up here, so I'll answer them very soon. Basically, with regards to safe havens, So people are investing in gold. They're investing in property, some of them. But what I can tell you now is what's happened today, which is in a day, we've lost 7%. Okay. By the end of this week, we will be close to minus 20%. Okay. What that means is if you had put money in, right, this morning, let's say you put $10,000 in, by the end of the week, you would have lost $2,000. So 20%. That will never, ever happen in property. It will just never happen over a period of a week or even in a day to lose 7%. It's not going to happen, right? So this is where you need to start getting educated, start understanding that the purpose of shares is like, I mean, it's got funding, the government, the company's going to operate still. But the core value, you can't look at real estate just as another asset class that you go, okay, well, let's just do some diagrams and, oh, it's times this by the income and whatnot. It doesn't work like that, because at the end of the day, property is where people need to live. They need to have shelter. It's a basic human need, right? So when you start thinking about it that way, it's like there's only a limited supply in a given location, okay? So for instance, if you wanted to buy in, let's say, Surrey Hills, okay? You only have a parcel of land that you can purchase. It's infinite, it's scarce, right? So what that means is if you can purchase in that area, people are gonna have to move out west and further out in order to get sort of, the same sort of location and same sort of lifestyle. Essentially, if you're able to buy property, you're buying land, right? But you're getting them paid off. So if you've got, say, 10 houses that you purchase and 10 seems like, oh my God, how the hell do I get to 10? It's very possible. And it's not what they used to say, like, oh no, you can't have 10. Yeah, well, you can't have 10 $1 million properties in Surrey Hills. It's not gonna work. You need to get educated about how higher yielding assets are actually the way to go. And then you can build capital growth, and together that will form part of your strategy. Most people are going, oh no, I just want capital growth, and that's what I'm gonna retire on. I was just talking to someone who, she's actually, acquired a lot of assets. She's basically at the point where she's got about $4 million worth of assets, but they're all based in Sydney, okay? She can't retire. She's got $4 million, just think about this, $4 million worth of assets in Sydney, but cannot retire because the rent she gets in from there is not enough to survive. So the percentage is what's important. And if you start early, it means you have to do less as you go along. It's very, very important to understand that if you have the advantage of time, now most of you, based on who I'm seeing is on here, have been working at least for 2 years full time. You should technically, most are living at home. If you have $30,000 in your bank account, you need to message me ASAP, okay? Because I'm telling you now, not just because I'm in this now, it's because I know what's about to happen in terms of where this is heading, has been heading here for the last 6 months to a year. I've been telling people close to me that you need to start accumulating debt, you need to start getting into investments, because the market will shift. And when it does, you've just got to ride the wave. Once you've ridden the wave that everyone's like scared and whatever, you've picked up all the assets you needed to pick up, then we get into the upswing and, the government's happy, everyone's putting money into it and everyone's happy. There's all this FOMO shit. When that kicks in, your asset prices inflate, your debt's going to be down here, and all you do is take out the equity, chunk, and start buying more. And then you're financially free. So you don't have to now wait for 65 when you can get your super and then put that into a stupid super bank saver account or whatever it's called, only to then earn like 1% interest. It's dumb. It's really dumb money. A lot of people, I know you may be thinking that you're going on and saving all your money and you just talk about property and shit, but look, this is free advice. It's not even advice. I'm just talking about it, expressing my views, and I'm telling you what I'm doing. I've got $3.1 million worth of debt. If I thought there was something wrong in the system and that I was going to get effed over, why the hell would I be at 3.1 million of debt and then ask for more? I'm constantly asking the bank, hey, can I borrow more? And how do I get more? because I know where the assets are. I know that's what I do every day, is I want to know how I can get access to those funds, and it's going to become easier, but only for a short period of time. And when it becomes easier and the cost of borrowing is so low, you're going to be in heaven, my friends. You are going to have financially secured yourself financial freedom, and it's going to happen a lot quicker than most people could have got to that point because of, you know, our lending situation and where the economy is right now. So, you know, the other part to the interest rates is that we will not see, right? And you can, I don't know how you can screen record this or whatever, but you will not see home loans go above 4% for the next 10 years, okay? The hardest part of paying off an investment or a mortgage is your first 10 years, because just the way it's been created is that in the majority of the first chunk of that 30-year loan, you pay down more of the interest versus the principal, okay? If in the first 10 years, you already know the interest rates won't go above 4%, well then, you've paid down the hardest part of the investment strategy, like the property, in the first 10 years, and it's been below 4%. You're making a net yield of like 6%. Like, it's really a no-brainer, right? So for the first 10 years, knock off a majority of your loan. You've accumulated, you know, 10, 15 properties. And then when you know that the time's come for, you know, that upswing to happen and now inflation's into the system, you've taken out all your equity, you've bought more properties, and then all you have to do is fix your rates for 5 years, right? You're still going to be paying. So for the first 10 years, you're going to be on, you know, 3% or whatever it is. And then you're in a position where the interest rates will start going, oh, now the interest rates are going to go up. And everyone keeps going, oh, what happens if the interest rates go up tomorrow? Well, it's not. You're just uneducated. You don't know what you're talking about, because it can't go up. If it goes up, the whole system comes down, right? And the government, like, it just can't. If you understand the mechanics of how it works, it just can't afford to do that, right? A lot of people also are talking about how the share market's come down and maybe it's a good time to buy. It is a good time to buy. Anytime's a good time to buy if you're planning to hold for a long term. So if you're planning to hold for 20, 30 years, which is the way you should be looking at it, we're all young, is if you're looking at that, then 100%, great time. But there is other ways you can utilize the money most efficiently. Now, my strategy, right, is I've accumulated these assets, and there's going to be a time that the bank may go, you can't borrow anymore. Right now, I'm at the upper limit, so they're not going to allow me to borrow anymore. And that's okay, because in 6 months' time, they're going to allow me to borrow more, right? And what will happen is I've got to ask myself the question that if I've got $10,000 in my bank account versus $10,000 into a property deal, am I making more in the $10,000 in my bank account, or am I making more as a return in my property investment? And the answer is that the property will grow a lot more than what it will in my bank account, because it sits there and does nothing. What's going to happen is in 10, 15 years, when the market shifts up and the asset prices inflate, then all I have to do is go in and take out the equity, and then the equity I'm going to plug into the share market. You're going to sit there and say, oh, I've held on to my $20,000, yeah, whoop-de-doo. And then the $20,000 will become $30,000. And then you're going to go, oh, I'm going to put it in the share market and then I'm going to make money, right? You're $30,000. Whereas I'm going to go in and I've bought all these properties, right? And you're going to think I'm an idiot. And then the prices will go up. Then I'll take chunks out, right, of $100,000, $200,000, $300,000. Take that and then put that into the share market. Now, is your $50,000 or $20,000 going to grow more than $200,000? No, it's not, because it's a percentage game, right? You got to be understanding how, you know, different things would work. But that's basically what's about to happen. And, you know, there's about 10, 12 of you guys that are on here. And I hope you guys take action from this. Do you know what I mean? So yeah, that's where I'm at. What happens after the crash? Well, I've just talked about that. You basically will get a period where economic growth is going down, which is where we're at. And then they're going to have to put in all this money, and then it comes back up. And when it comes back up, then that's freedom, guys. That's freedom. Then you can sip on pina coladas. What else do I have here? Cashless society. So you know what you guys should do is Google the cash ban, understand why they're doing it. So basically it's illegal to have cash transactions of $10,000 or more. Do you know the reason why they're doing that? Here, you know what? It'll be fun. I'll talk about it. So negative interest rates will happen, okay? Which it's wrong. It's the opposite of what you've been taught. So if I take out a mortgage right now, I pay back 3%. When it happens, and it will, I will take out a mortgage and the bank will pay me 1% for the mortgage, okay? So not only will I make money from the rent, I will then get paid by the bank to take out a mortgage. It sounds absurd, it sounds silly, but it will happen, okay? So when this happens, you've got to think investors like myself are basically just waiting. We've got all our assets already there. Once the asset prices even go up by 10%, you just take out a lump sum, right? Because if I've got assets worth, 4.5 million, right? 10% of that is $450,000. So in a year, 10% goes up, I'm taking out $450,000 and I can do whatever I like with it, right? That's because I'm in the market. If you're sitting on the sidelines and just waiting for the perfect opportunity, there is no more perfect opportunity than today. We are in such a unique position and you guys aren't taking advantage, which blows my mind. There's an ebook on my website. You need to go download that. It gives you a bit of insight about what I'm talking about and the mentality of why I'm doing it. And then we can have a chat, like a proper strategy session where you may think you've been taught the right things, but there's just no way that in 5 years I've been able to accumulate so much without having a blueprint. Like, it makes sense. I live and breathe this thing because I like it. And when you like something, you're generally going to spend a lot more time trying to learn it. So my advice, non-advice, really is to accumulate as much debt as possible right now. We have a time where the cost of borrowing is so low. We're going to get into negative interest rates, and that's going to be an amazing time, except the economy is going to be like, it's going to go bonkers because it's the opposite of what anyone should be doing. So it's going to be interesting to keep an eye on that. And that's pretty much all I wanted to talk about today, guys. I've got a few questions here, so I'll just answer those. We've got here, I thought you can only take out your super under certain circumstances. Yes, you can. That's correct. However, I'm not saying take it out. I'm saying you need to convert your super fund into a self-managed super fund. This is not advice, by the way. Just so, don't get all weird and shit about it. Is self-managed super fund, so that's what I did, is when you get your self-managed super fund, it will literally sit in the bank account as if it's your funds, right? And you can invest it however you like. So if you wanted to invest it the same way your super fund invests it right now, you could do it. But do you think when we've had a conversation like this and the market this week is going to drop by another 10, 15%, do you think you can go in and tell your super, hey, Mr. Super Australian, these stupid Australian super bullshit, industry super funds, and go, hey, by the way, look, I think the market's going to come down. Do you mind taking out my money? They're not going to do that. Whereas if you have a self-managed super fund, you can do those things. And you can also use your self-managed super fund to buy property, investments, and obviously there's, tax implications and things like that you need to consider, but that is definitely what we can talk about. I think next week we're catching up for a strategy session, so we will talk about that then. Wouldn't a lot of people be investing now than if the market has dropped? Yes, a lot of people are thinking that right now is a great time to buy, but people are scared. Exactly what Himi was saying. They're scared because they're thinking, well, how far can the market go? And then the other half of people are going, well, yeah, the prices are really low. Let's buy. Well, it seems low when it's 20% off, but you know what seems lower? When it's 50% off. And that's when you should buy. So it's just all perspective, right? If I said to you, I can get you a house for $400,000 in Sydney today, you would say, yeah, sign me up. because in context, you know that the median price here is $1 million. But if I said, I can get you a house worth $1 million, suddenly it doesn't seem as attractive, right? But if I said, oh, well, you're guaranteed it's gonna go up by 10% every year, then you probably will. But don't invest in Sydney, my friends. Sai, can I swap to SMS now with the current funds in there? Yes, you can, but no, these are good. Keep the questions coming. You can change it to self-managed super fund. It does take time though. So watch your super funds. I'm not trying to scare you guys, but keep an eye on it, because I'm telling you, it's going to be more entertaining than a thriller Netflix series that you're going to watch in the next month or so. It's basically going to go down and you're going to cry because all that money that you made, you're going to hope that it's going to come back. And it will, but you could have used it elsewhere. I personally took out all my super money and invested my self-managed super fund. So I suggest maybe it's something to look into. We've got another question here. Where do you suggest we invest? So obviously there are clients that are going to be paying for those services, the buyer's agency services. So I suggest you hit me up, download the ebook and then book in a call, and then we can tee up an actual strategy session. That's when we can actually talk to you about what you can buy and can't buy. Because right now it's no perspective, right? It's me saying, well, you should go outside and buy a house in Bondi. But does that work with your strategy? Does that work with what your lifestyle looks like and your age group and, all these other factors that need to be considered? So I'm very careful about what I tell people in terms of where to invest, because different things apply to different people. And without education, some people are taking it for what exactly I'm saying. So if I say you need to get cash flow positive property, but you actually don't because that's not where your strategy is, then you're in trouble. Whereas if I say to you, you need capital growth properties, but you want to maintain a lifestyle, well, then you have a problem. So that's why I say a strategy session is important. I didn't want to make this too long. What are we at? Like close to about 45 minutes. So hopefully you guys didn't get bored. And I think I might make this a weekly thing. I might make this, every, 2 weeks. I don't know yet, but keen to hear your feedback, guys. I'm thinking of putting this up on YouTube as well. So let's see. Let me know what your thoughts are. Really appreciate you guys coming out, and more so because I'm very happy for you guys that you guys are taking this a bit more seriously. You could have been doing a lot of other things on a Monday night. Like what's everyone watching? Like Married at First Sight or some shit. It like blows my mind how you can work all day. But if I tell you that what you're doing right now, you're basically working a few hours a day for free, because that's how much money you're wasting. But people won't get it. That's okay. People like yourself and myself that are here, we can really take advantage of it. So guys, thank you so much. And hopefully for the next time when I go on, we get a few more people on. But thank you. Thanks, guys. All right, guys, so that was basically a live session I had on my Instagram channel. You can find the details below of how to be at the next live event, and you can ask questions as well. So it makes it a lot easier if you're on the live session. And I'm going to try and do these weekly. So let's see. There's a lot of volatility in the market. So I really want you guys to stay upbeat. And I know sometimes it's not possible at 9:30 coming on live, but you do get the added benefit of live communication, live commentary, and those question and answers keep coming back and forth. So I do advise that you follow the page and keep in tune with the next one. But for now, just subscribe to this YouTube channel. Even if you're not in a position to purchase in the next 6 months, I suggest you start getting educated about it. And there's no better way to know that than to actually learn from someone your age that's doing things that you want to do. You don't know what you don't know, so it's time to start taking that accountability and start doing those things. So I'll see you guys in the next video. Peace out.